because yes, Iran's still unresolved. Oil prices are heading higher, but the last 3 weeks we have etched a new all-time high, right? And before we get into really what's driving it, it's probably worth spending a second here on new all-time highs, right? Most people we talk to tend to overthink new all-time highs, and they think it's some type of sell signal in the marketplace, right? But it's really the opposite. Historically, the market has rewarded new all-time highs by new all-time highs, right? It's the law of inertia. Momentum begets momentum. And typically when you see indices, sectors, a handful of stocks hitting new all-time highs, right, it's some signal strength in the underlying data that the market likes, right? On the flip side, though, the market can also work in reverse, right? So momentum works the opposite direction at the same way, right? New lows are typically exacerbated by new lows. Obviously, we're fortunately on the flip side of that right now, but don't want investors thinking that they should be spooked right now because we're at all-time highs. Yes, there's some storm clouds definitely hanging over the market, the economy with things like that, but new all-time highs are not just a sell signal in the marketplace. Now that brings up the question, what's driving these new all-time highs, right? It really comes down to two things that we see right now, right? So earnings, and then some better than expected economic data that's really kind of turned the market around these last 3 weeks. So spending a second here, let's dive into the earnings side of things, right? We're wrapping up Q2 earnings season, and earnings have been very solid, right? So according to FactSet, earnings growth has been 50.4% year over year. You have to go back a handful of years to see earnings growth that strong, right? Go back to 2021, coming off the easy comps of COVID, right? So earnings have been very solid. Coming into earnings season, Wall Street was penciling around a 23% earnings growth, right? So we far exceeded that. Obviously, the market likes when it beats expectations, right? And then sticking with that theme, 86% of companies that have reported higher than expected expectations or earnings higher than expectations, right? And so 86% of those companies, that's one of the best on record as well. So companies are growing their earnings and they're beating expectations. And so that's really what's driving these stock prices. And we talked about in the long run, earnings drive stock prices, and that's really what we're seeing, right? So fundamentally, markets acting very rational right now with very strong earnings growth. Now, on the flip side, the other thing why the market has really started to accelerate here the last 3 weeks is better than expected data. This week was on the CPI front. So CPI came in remarkably actually in line with month over month and year over year expectations. And there was also no revisions for the month of July. And yes, the market liked that. When you look at the probability for a Federal Reserve interest rate hike, that actually came down from 80% at the beginning of July down to about a third right now. So we've really seen a huge recalibration right now with the market expectations for the Federal Reserve. And the part that kind of strange to us though, right, is the market's still expecting a third probability that the Federal Reserve will actually hike interest rates, right? And let me explain why we think that's a little bit strange, right? So July CPI came in at 2.5%. Yes, that's above the 2% target for the Federal Reserve. But if you go back to last September, right, the Federal Reserve cut interest rates 25 basis points when inflation was running at 3.1% year over year. So 60 basis points higher than it is today, and all 12 members were in consensus that they should cut. And there's actually one member that wanted to cut interest rates 50 basis points. So now fast forward to today, we're running at around a 2.5% year over year clip. And there's actually 3 members on the Federal Reserve from last meeting that wanted to hike interest rates 25 basis points relative to a year ago when we're 60 basis points higher and everyone wanted to cut interest rates, right? And it's the same Federal Reserve, a lot of the same members, right? Obviously a new Fed chair, that's really what's strange to us. And we honestly generally don't know. It's probably that these members think that inflation may start to get out of hand, and they rather snip it in the bud quickly than let it go back up to a 3 handle. But obviously we're still above the 2% target. But right now, expectations for an interest rate hike next month have really come down to about a third right now. We'll see, obviously, as we get closer to September. And then besides the Federal Reserve, I think the two other things that could probably kind of unhinge this rally, right, would be a stronger dollar or something that happens in the credit market, right? Yes, we have midterms that are looming out in November, but in the short term, that's really what we're paying attention to that can probably knock this rally off its tracks. Now, as we put a bow on this episode, a lot of people think that these bull markets are easy, right? They never are. There's always scary headlines out there. Every year, every cycle, they're different, but there's always headlines out there, right? So congratulations for the people that stayed invested, stuck to their plan, right? We're sitting at near all-time highs right now, so that's discipline, right? That's perseverance. But obviously that volatility is the toll that we invest, right? And we talked about it before. But at the end of the day, right now we're sitting at new all-time highs. Yes, there's definitely some things that could knock this rally off its tracks. But right now, earnings growth has been very solid. Inflation came in better than expected, and so that's why we're sitting at all-time highs right now. We'll catch everyone next week, though. Thanks for tuning in, and have a great week ahead.